Capital One is making waves with game-changing first-quarter results and strategic moves that are set to redefine its position in the market. From exceeding profit expectations to the transformative $35 billion merger with Discover Financial Services, Capital One is paving the way for monumental growth. With analysts raising price targets and impressive improvements in credit metrics, this powerhouse has plenty to offer. Stick around as we unpack the key highlights, future potential, and why this might be a stock to watch. We covered the stock before, you can check it out. We'll put the link down below. Even Mr. Jim Cramer mentioned this stock many times this year. And if you enjoy this deep dive, don't forget to give this video a thumbs up, subscribe to the channel, and hit the notification bell so you never miss the latest updates on market insights and financial strategies. Friendly reminder, we are not a financial advisor. Please do your own research before you do the investment. Let's get back to the stock. Capital One shares climbed on Tuesday evening following the announcement of first-quarter profits that exceeded expectations, largely due to strong credit quality metrics. With the upcoming closure of the Discover acquisition in less than a month, the stock might have further upside potential. U.S. stock futures also surged Tuesday evening after President Donald Trump said he has no intention of firing Fed Chair Jerome Powell. The president also acknowledged that tariffs on China will not remain as high as 145%, although the timing of when they could come down was unclear. Capital One posted solid first-quarter results, and a larger-than-expected reserve release in its credit card business should ease some near-term concerns about its customers' ability to pay off their balances. More importantly, the business has momentum ahead of the closing of its $35 billion acquisition of Discover. We maintain the view that this deal offers Capital One stock a twofold advantage. It not only significantly boosts earnings per share through synergies in the network and expenses, but we also contend that it has the potential to enhance the price-to-earnings multiple. For example, Capital One's soon-to-be vertically integrated business model would look a lot more like American Express, which also owns a payments network like Discover. Shares of American Express trade at about 14.5 times estimated 2026 earnings per share, while COF trades at roughly 9 times forward earnings. We're not arguing Capital One should trade at the same multiple that American Express does, but there's a compelling case that the discount should narrow. With the earnings accretion and acceleration in share repurchases from the deal still underappreciated by the market, we reiterate our buy rating and price target of $210 a share. Why own it? Capital One's acquisition of Discover Financial Services is a transformative deal with significant strategic advantages and financial benefits. We expect the deal will create value for merchants, small businesses, and consumers. There are also several billions of dollars worth of expense and network synergies that should make this deal highly accretive to earnings per share. Lastly, the acquisition strengthens Capital One's balance sheet, allowing for aggressive share repurchases in the future. Capital One stock has suffered from recent tariff disputes, not due to direct impacts of higher tariffs, but because an economic slowdown might jeopardize its credit performance. However, the first-quarter results revealed better than anticipated credit quality. As the chart shows, both net charge-offs and provisions for credit losses came in below expectations, leading to a bigger reserve release than expected. At quarter-end, Capital One's total allowance for credit losses stood at $15.899 billion, representing a coverage ratio of 4.91%. That's down 5 basis points from the fourth quarter of 2024, thanks to improving loss trends. These metrics are relevant to Capital One because it also has a banking arm, even if its credit card business is much larger and more associated with the company. Net charge-offs refer to the amount of debt a bank has written off as uncollectible, minus any recoveries. Provisions for credit losses are funds that Capital One sets aside to cover potential loan defaults. Lastly, the allowance coverage ratio measures how much the bank has to reserve to absorb potential losses. It's calculated by dividing the total allowance for credit losses into total loans held for investment. Within its card portfolio, Capital One experienced improvements in delinquency rates and payment rates, as well as a decline in new delinquency entries, positive indicators for investors concerned about the financial well-being of its customers. CEO Richard Fairbank emphasized that delinquencies serve as the most reliable leading indicator. During the call, he noted that delinquency rates remained stable on a seasonally adjusted basis for most of 2024 and improved beyond seasonal expectations over the past 6 months. More recently, Fairbank called out an uptick in spending in recent weeks. He explained some of this could be explained by the timing of the Easter holiday, but there was also strength in retail spending and in auto purchases, which are likely due to a pulling forward ahead of tariffs. As for where spending has eased, Fairbank called out travel and expense growth and airfare. Fairbank provided further insights on the broader economic environment, stating that the U.S. consumer continues to be a pillar of strength for the economy. He acknowledged that certain groups of consumers are experiencing challenges due to inflation and rising interest rates. However, he noted that the company is still observing delayed charge-off effects from the pandemic, though the improvement in delinquencies suggests this impact may be easing. Overall, he described the U.S. consumer as being in solid condition. As seen in the chart above, non-interest expense was among the areas where Capital One missed expectations, but some of that was attributed to a $110 million pre-tax expense related to Discover integration costs. Higher marketing expenses were another driver of the increase. The company spent more on direct response marketing, media spend, and investment in premium benefits and differentiated customer experiences like airline lounges, travel portal, and Capital One shopping. Following last week's regulatory approval, Capital One is on track to close its acquisition of Discover on May 18th. The company said Tuesday that it continues to expect it will achieve the originally announced synergies, estimated at the time the deal was announced, though the timing of achieving them will be pushed out by about 6 months due to the delay in closing. Still, the deal synergies are significant. As a reminder, management expects the transaction will generate a total of $2.7 billion in synergies, split between $1.5 billion in expense synergies and $1.2 billion in network synergies. This is a result of moving Capital One's debt purchase volume and selected credit card purchase volume to the Discover network, reducing the amount of fees it pays out to MasterCard and Visa. After the deal closes and Capital One completes the Federal Reserve's annual comprehensive capital and analysis review, we should start to see the company begin aggressively returning excess capital to shareholders. Analysts upgrade the stock today. John Hecht, an analyst from Jefferies, maintained the buy rating on Capital One Financial. The associated price target was raised to $200. John Hecht's buy rating for Capital One Financial reflects its strong quarterly performance and strategic initiatives. The company exceeded earnings expectations with an adjusted EPS of $4.06, driven by improved credit performance and lower provisions. Additionally, its net interest margin expanded due to robust deposit growth and a favorable loan mix. Strategic emphasis on the auto and card segments, along with the merger approval with Discover Financial Services, supports future growth and enhances Capital One's market position. These factors collectively strengthen the positive outlook for the stock. In another report released today, BTI Ag analyst Vincent Koenig raised the firm's price target on Capital One to $264 from $208 and keeps a buy rating on the shares. While the lack of synergy updates was disappointing, BTIG came away from first quarter earnings incrementally positive on fundamentals. Capital One is setting the stage for an extraordinary leap forward. With better-than-expected first-quarter results, a transformative $35 billion Discover acquisition on the horizon, and billions in synergy potential, the company is revolutionizing its market position. Improved credit performance and strategic advancements are not only driving momentum, but showcasing Capital One's resilience and vision for future growth. Analysts are raising price targets, highlighting the unmatched opportunities ahead for investors. This is just the beginning of Capital One's game-changing journey, and you won't want to miss what's next. So, hit that like button, subscribe to our channel and ring the notification bell to stay informed and inspired by the latest financial insights and success stories. Thank you for watching and see you in the next video.